Welcome back to the Money Bear podcast. Today I've got my friend Ronnie on from Rhythm Accounting. Ronnie, how's it going?
Going pretty well. Thanks for having me.
Of course, we're excited to have you on. Before we get into all of our very fun tax questions, tell the people, who are you, what do you do, where you're based, all the good stuff.
All right. So my name is Ronnie Goode. I'm a CPA, certified public accountant, licensed in the state of Virginia. That's where I currently reside. I love Virginia. I'm in Central Virginia. I used to be in Northern Virginia. What I do is I help business owners, investors, entrepreneurs. I help them utilize the tax code and leverage it in order to build wealth. Okay. So it's different from just doing taxes, right? We're using the tax code, leveraging it to build wealth. So that's what I do. That's where I'm located. I've been doing this for a very long time. Hopefully, I still look a little young, but yeah, that's.
I was gonna say, I was like, how have you been doing it for a really long time? You look like you're not even over 27.
I appreciate that. I appreciate that. The guys tell me that when I play basketball too, so it makes me feel kind of good about it.
Like, you're like young forever, drinking from the fountain of youth in Virginia.
Yeah, exactly. Until you tell them that your age, and it's, oh my God, I'm like. Come on now.
The oh my God is great because it's, whoa, hold on. It's not that old. Okay. Thank you very
much. Yeah, it's not that old.
I love it. I have some fun questions for you today, and I'm excited to dive in. So let's get to it. Okay. My very first question for you is, do you ever see bad tax advice on TikTok or Instagram? The internet, of course not. Everything on the internet is true.
Everybody is experts. Everybody knows what they're talking about. I see a ton of bad tax advice online, and it scares me a little bit. So it's part of our job as professionals, as specialists in this area, to put out information to balance it out, because the internet is the Wild West. It's not really regulated in terms of information. And someone could take just a concept that they read about, oh, I understand the concept, and present it as if they are experts. And that's unfortunate, because then the actual professionals have to clean it up. These folks get in trouble. People listen to them and it's, oh, okay, I can do that. Now I'm going to try to do that. If you don't get the nuances and the details, really how to execute some of this stuff, because the devil's is in the details. If you don't get the details, how do you really execute this? I understand the concept. How do I apply it? If you don't get that, it's going to be bad for you. And it's tough dealing with taxes because someone else is looking at your stuff, right? We have to be accountable to the government. And they can come back, they can fine you, jail time, all of this stuff. And I put out some of that stuff, and I'm not trying to scare people on my page, but I'm like, this is what's happening out here, and this is what can happen to you. So just be careful listening to just anybody. Always, what I like to tell people, if you hear something on the internet from somebody, even me, right, take it to your CPA and discuss it with them. To say, hey, I heard Ronnie say you can do this thing. Because on social media, we only have about a minute and some change to get out some information and reel them in. But just take that and just go discuss it with your tax professional, CPA, and see if it can apply to your situation.
Yeah, 100%. But have you seen anything that you're like, why are people talking about this? Because the one I always think of, and what I was leading with, I bet you know what I bet you know what I'm going to say.
Yeah, I do. Yeah.
It's the one where everybody's telling everybody to buy a freaking G-Wagon.
Oh my God. Oh my God. Oh my God.
I feel like I see that everywhere on people's pages that they don't even have anything to do with taxes. It's, oh yeah, this is why people buy a G-Wagon. So tell me your thoughts about that.
So it's one tax strategy that has been exploited and abused. It's only for a specific group of people. And the reason why people use G-Wagon and stuff, because that catches people's attention. Oh, I can buy a G-Wagon. I can write this off in my business. Then they give some simple information. Just all you need to do is just set up your LLC and you can. No, it doesn't work like that. There are a ton of different steps that you need to go through first in order to be able to do that. And they use the G-Wagon, but it's not just the G-Wagon. It's cars with a certain weight. Right. And you have to use it for your business and all of that good stuff. But you have to have the income to justify such a deduction. Okay. So if you don't even have the income, if it's not economical to your business, then you're raising all types of red flags. And that's an easy one for the IRS examiners to catch. That's really easy. That's you giving them an alley-oop. Thank you. Oh, the G-Wagon, but you only made $40,000 in your business, but you're writing off a $126,000 car.
Oh so my gosh.
The deduction is not in proportion to the income.
Oh, that's so, I didn't even know G-Wagons were that expensive. That's insane.
Yeah, they get up there. They get up there. Yeah.
Holy crap. It blows my mind. I feel like I see that everywhere. And I'm always like reading through the comments of people who are like, their minds are blown. And I'm like, whoa, how much money are you making from your business? Do you even have a business? And half the time people don't even have a business. And they're like, I'll just start a fake LC and this will all work out great.
Yeah, it's not going to work out great. It's going to go really bad for you. And at the end of the day, what I always tell people is if that person is not signing your tax return when they file it, because we have to, as a CPA, any tax return that I prepare, I have to put my name on it, right? If that person is not signing your tax return, be careful just taking a concept and just trying to run with it. Be 100%. Careful.
Yeah. And I will say too, I feel like, because people have seen me talk about like financial advisors and how good ones are a dime a dozen. I do not feel that way about CPAs. CPAs, it is a whole other ballgame out there. You guys can absolutely learn how to invest for yourselves, but you cannot learn how to DIY your taxes at this level. And like, we're talking for like small businesses and things like that. Usually a W-2 employee, I'm sure you can agree, they have simple taxes. They can use a TurboTax, they can use an HR block. But when you're getting into complicated strategies as a small business owner or a real estate investor or something along those lines, this is not something you want to try and DIY. You want to hire a CPA, and specifically a CPA.
Yeah, you hit the nail right on the head, but let me just add a little bit to that. So not all CPAs focus on tax. Just put that out there. So you want to hire a CPA that focuses on tax, because the CPA exam prepares us to be well-rounded as accountants. So it's covering multiple different areas. And some CPAs don't even touch tax at all. They hate it. I do some CPAs taxes. I give them tax strategy, but they are CPAs, but they focus on other areas like audits or some other mergers and acquisitions. They're doing something totally different. So you want to get someone that specializes in tax, and you want to get someone that spends their time in tax, because the tax code is huge. And there's been some debate about this, but it is said, and don't hold me to this, it's said that the tax code, if you print it out, is over 70-something thousand pages long. Somebody,
that's
told me
not a book I want to read.
Yeah, right. Someone told me that it's a lot shorter than that. It's about 5,000 pages. I'm like, okay, that's still long if it is. But just to let you know that it's huge. The tax code is huge, and no one knows the entire tax code, but people try to master aspects of it. That's why I focus on business owners, real estate investors. Then you got other folks that do estate planning and things like that. So it's important that you get somebody that specializes in a certain area, that works in it continuously, studies it continuously. All I talk about is taxes on my page. You see my stuff. It's like taxes again. Yep, taxes for breakfast, lunch, and dinner. That's all we do. You know what I mean?
Yes, exactly. But I also I gotta say, I love that Instagram has helped really highlight different professions, because you do get to go and see the passion behind somebody and their work. For me, I'm a lot more likely to hire a CPA where I can see them educating people and I'm actually learning something from them on the internet. Now, I'm sure there's pros and cons to that, but it is nice to understand, okay, this CPA specializes in this thing. This CPA is specializing in these things. So the internet's a great place, but it's also filled with misinformation as well. So luckily we got people like you and me coming to the rescue.
We're going to save everybody.
For sure. Always with the disclaimers though.
You have to, yeah.
So for you and your experience, what would you say some of the biggest misconceptions about taxes out there? Like people coming to you with these thoughts on what they can do, what they can't do, anything along those lines?
Yeah, so I like to talk about taxes from a mindset perspective. So the misconception is taxes are here to just take your money, instead of looking at the tax code from the perspective, shifting your mindset as the tax code is full of incentives. Really, you think about it. The government is trying to incentivize you to act in a desired manner, but you just have to carry out those behaviors, right? Most people don't look at the tax code from that perspective. They just look at it as, okay, they're trying to tell me how to pay taxes, but a good portion of the tax code is telling you how to save money on taxes. When you really look at it from a certain perspective, this is why business owners get all of these write-offs and deductions and things like that. It's because the government is incentivizing business owners, because business owners create jobs. Okay, so I want you to create more jobs. So I'm going to give you incentives to create businesses, because I know businesses result in creating jobs. So when you look at the tax code from that perspective, hold on, it's all kinds of incentives in this thing.
I love that. I've never thought about it that way before. I literally wrote that down I was like, we're going to make a reel out of that. That's
yeah,
perfect.
right. Yep. Same thing from a real estate perspective, right? Real estate investors, I love real estate, by the way, from a tax perspective. Real estate investors, they create housing, right? The government wants housing, right? They don't want to do it themselves. They may not even be the best at doing it themselves. So they're going to incentivize all of these real estate investors because they know that real estate investors are going to create housing. So they give you these elaborate deductions and things of that nature. So if you look at the tax code from that perspective, you can utilize it to your advantage instead of feeling like it's taxes again, estimated tax, my quarterlies, as a business owner, you know, that stuff, you know, you can kind of shift your mindset to look at it from the perspective of, hold on, if I do these things, I get those benefits. I'm going to do more of those things.
That's so smart. I love that because it seems more like like there's a strategy behind it. But I immediately thought of like retirement accounts. The tax savings you get on retirement accounts is an incentive to use those retirement accounts. That's what I always tell people is so many people go straight to the taxable brokerages because they're like, oh, I have more control and I can use this to my advantage. And it's, first of all, you need to be saving for retirement, and that should be your first priority. Secondly, you're saving on tax. You're missing out on easy tax savings. Those are like, I feel like those are one of the easiest ways to save money on taxes. Would you agree?
Those are some of the easiest ways to save money.
All you gotta do is put money in it. That's it. And then boom, you save money on taxes.
It's flexible. You can use it, but online, right? On the internet, you hear a lot of people that speak against it. Ks are bad. People that speak against it because, okay, it's tax deferred. All right, cool. If it's not a Roth. Okay, fine. You still need to be getting a benefit from that, and you still need to be saving for retirement. 100%. Nothing is bad about doing that at all.
Yeah, and the thing is, the people who say those are bad, they are almost always trying to sell you something, and it's almost always insurance. That's the thing. I even said that the other day. I was like, somebody asked me on my free class, they go, what do you think about whole life insurance? And I was like, you got to notice, like, the product itself is not bad. There's nothing wrong with the product. The issue is the way that it's sold to you. Think about it. No one's selling you a Roth IRA. No one's selling you a 401k. It's because these are just products that exist that you can use to your own advantage, and they don't need to be sold to you. But those insurance products, man, we could go on a whole side tangent about that stuff. But so anyway, yeah, I feel like that's one of the most easy ways to do it. And for those who are listening and you're like, I don't know the tax advantages of a Roth IRA versus a traditional, can you give us a very quick rundown of what those advantages are?
Gotcha. So traditional IRA versus Roth IRA. Traditional IRA, pre-tax dollars that you're contributing to the account, which means that you're going to get a tax deduction for the contribution. It's going to defer your taxes until your retirement, or unless you do some other strategies down the road. You should talk to a CPA about doing that. Roth IRA are after-tax or post-tax dollars. The money is taxed today. You contributed to the account, grows tax-free. You withdraw it tax-free in retirement. That's the basic level of how those two work. I love Roth accounts. Everybody should have a Roth account. I wish I would have started a lot earlier than I did with the Roth account. Significant advantages for those.
Yeah, for sure. Same. I wish I had. I always tell people, like, you're never going to regret starting when you did. Some people are always like, should I start right now? And I'm like, I tell you what, 10 years from now, you're going to wish you started right now. So yes, the answer is always yes.
Yes, please. I love a Roth account.
Yes. Oh, yeah.
Because even when talking just from a real estate perspective, really quickly, let me just give this. I'm excited about this stuff.
Oh, yeah. Oh, yeah.
So from a Roth account perspective, you even look at folks like Peter Thiel, right? That's the guy that has a $5 billion Roth IRA or something like that. He has a significant amount of money in his Roth IRA. And one of the things that a Roth allows you to do, or a retirement account allows you to do, is you can self-direct it. You don't have to invest in securities. You can. I love stocks and stuff like that, but I also love alternative assets like businesses, real estate, and things like that. So Peter Thiel, he was able to self-direct his Roth IRA and invested in companies. Those companies blew up, and he continued to do this cycle. Now he has all of this money into his Roth IRA that's going to be tax-free, and the government hates it, of course, but they allowed the vehicle to actually do it. So get a Roth IRA. I can spend a lot of time talking about it, but I love that account.
Now I have a question, because in order to do that with the self-directed IRA, how does one even go about opening a self-directed IRA? Is it the same simple process that it's like online and you just open it at Vanguard, or do you have to get like special clearances to do that?
Yeah, so I don't think they offer those type of services. I think they only offer like securities, but companies that you have to go through that will allow you to actually do this. Okay. Once you go through those companies, it would allow you to treat your invested retirement funds, they self-direct them, and you can invest in like physical real estate, if you will, rather than REIT. Options are endless, but you have to go through those companies in order to be able to do that.
And that is not a beginner strategy for the
that is not a beginner strategy.
And they're like, wait, they're like, Chloe has never talked about a self-directed IRA. And it's like, yeah, because you don't need it at the stage you are at, my friends. Everybody gets off of this and they're like, I'm going to go make $5 billion.
Right. Yeah. Yeah, it's not a beginner strategy at all. It's just another fun thing. I'm just trying to promote using your retirement accounts. It's okay. It's a good thing, guys.
For sure. And billionaires are using them as well. So
come on now.
All right. So you specialize in small business taxes and real estate, and we're going to dive into both of those. But first, for small business taxes, what are some of the biggest general tips that you've got for small business owners, especially now that we're November 30th as we're recording this? What kind of tips do you recommend for folks who are like panicking and they're like, I got to get my taxes together from my accountant?
So if you have a small business, the best advice that I can tell you as a CPA is to make sure that you're working with your CPA or your tax professional all year long. Okay. Do not wait until it's tax filing season to go talk to your CPA. Don't show up in April. Don't show up in January, any of those times. But let that be the last conversation you've had with them, because you've had multiple ones before that. So make sure that you're working with your CPA throughout the year on planning. Tax planning is very important. So I would say, make sure you're engaging with your CPA for tax planning all year round. Y'all should be having discussions at least on a quarterly basis. I have some folks that I talk to, they talk to me every day. Right? They call me every day. Ronnie, I'm thinking about doing this. Ronnie, I'm thinking about doing it. I'm like, don't do that. Capital gains tax on that. So we just play this game. And I have folks that I at least talk to on a quarterly basis where we do a check-in. I'm able to see how you're tracking throughout the year. And kind of right now, since you say the end of the year, people are panicking and things of that nature. So what I'm doing with a lot of my clients is I have a projected tax return already completed for them.
Wow.
So they already know where they're going to land from a tax perspective. They know what their tax liability is going to be. They know different things that we can do to make adjustments. They know that right now because we've been talking all throughout the year. I have access to their financial reports, their financial information, any other information. If they work a job and have a business, I have that information as well. That way we can pull any levers we need to pull from a tax strategy perspective before the year is out. Once the year is closed, it's not many things that you can do from a tax planning strategy perspective. We can do some retirement contributions. That's why I say it's good to have that flexibility.
Yeah.
But in terms of some of the other stuff, some of the kind of deductions and things like that, not much we can do once the year is out.
And that's why they call it tax planning. You're looking forward. You're not retroactively being like, oh shit, what do we do with this year that we just had? So that makes sense.
Yep.
Okay. And so like for somebody who is trying to shop for a CPA or a CPA company or something along those lines, what are some things that you recommend small business owners look for?
Okay, I would always recommend that you look for someone that's certified, because at the very least, it shows that they have a board that they have to be accountable to. So as a CPA, I have to be accountable to the Virginia Board of Accountancy. That's the state that my license is in. So I have somebody to be accountable to. I have professional standards that I have to meet, ethics and all of that good stuff. So that at the very least. I would also look to see who has experience in your particular area dealing with the type of things that you actually deal with. Okay? So if you're a content creator, have they worked with content creators? Are you a real estate investor? Have they worked with real estate investors? So on and so forth. So those are the key areas that I would say to actually look for. Do they have the training, background, experience, the credential, because you want them to be accountable to someone, because these are your taxes you're talking about. You can face jail time or penalties.
Correct.
Right? Yeah, at least that, and make sure that they focus on the areas that you focus on. I would say that will put you in a good place.
And go ahead.
No, I'm sorry. The biggest one, and I just mentioned it. Make sure that they do planning. They don't have to, but you need to have somebody that focuses on planning and strategy.
Yeah, no, that's a huge one because I realized recently that the people I am working with right now are not really that into the strategy side of things. So I'm thinking of outsourcing strategy for someone for other topics outside of them, but they're great for in terms of managing my bookkeeping and all that stuff and making sure things are done. But yes, it's one of those things that like as an entrepreneur, I get so overwhelmed with taxes and formation and like all of these other things that I have to focus on that are not my area of expertise or passion. So I am a huge like proponent of go hire it out, especially as a small business owner. You do not want to mess up your taxes. Yeah, it's been a huge release just to hire somebody. What small businesses, like if you had to say the majority of your small businesses are focused in X, what would you specialize in?
Oh man.
A wide range.
It is, but today I would say the majority of my clients are in real estate. That's why I carved out a niche for it today. Yeah. But before that, I have clients that are in trucking business. I have attorneys, professional. I have doctors because they have a lot of W-2 income. Yeah. Attorneys who are practicing on their own. I said trucking companies, have daycare. I have all sorts of content creators, have all kinds of folks on the business owner side. But recently, I've been getting a lot more real estate investors recently.
Yeah, I wouldn't be with your passion for real estate, which we're about to get into. I wouldn't be surprised if eventually most of your clients were real estate.
Yeah. I've been loving it. Yeah.
All right, let's talk about it, Ronnie. Okay. I know there is a lot of hype, and I'm going to give everybody a little bit of insight here. I am not a real estate investor. I am not somebody who understands real estate investing. I am not somebody who is even that interested in it yet. I could see myself eventually getting into it, but I have heard so much about the tax benefits of real estate. So, Ronnie, I want you to explain to me, what the heck are the tax benefits of real estate and why is everyone so hyped about it?
I'll make it quick and easy and then we can get into the details. I have one word and one word only. Depreciation.
I knew that was going to be the word.
One word and one word only, depreciation. So we can dive into the details of it. That's it? Yes, it's really, that's it.
In terms podcast, everyone.
Thank you. It's over, guys. In terms of the major deductions, right? It's about utilizing depreciation, but just real estate as a whole. Real estate is a good investment vehicle. One, because you get to get an asset. Let's say if we're talking about rental properties, get an asset that's creating cash flow for you, right? That's an additional stream of cash flow. A tenant is staying in it and paying down the principal, the mortgage that you got on it to get the asset. Also, it's likely to appreciate in value. So on the market, right? So you got all of those different benefits. And you want to add on the last benefit is that you get tax savings from it. It gives you multiple benefits from investing in real estate, just from all of those four things that I just mentioned. So on the tax side, you get all your regular deductions for interest, insurance deduction, any maintenance and repairs, and you get all of that stuff, right?
But the question on that part, how much money does that actually save you? I know it depends, but like, can you give me like an example?
Got you. So it really depends on the actual property, how much the property is, and what the mortgage is to determine what the interest is going to be. That's going to be a little difficult, but what I will say is this: the bigger deductions come from the depreciation. That's where the large deductions come from. Unless you just had a bunch of repairs and maintenance that you were doing all year. You were trying to get it ready to be rented. Those, you can get some big deductions from that, rehabbing and things of that nature. But the big deduction come from depreciation and utilizing depreciation. So let's get into what depreciation is and all of that good stuff. That's the magic. So depreciation, for folks who may not know it, is so when you get an asset, depending on how you acquire it, whether it's equipment, in this example, we're talking about property, there's normal wear and tear that's going to happen to the property, right? If you're going to have it for a certain amount of time, it's going to get rained on. You might have hail that hit it. May even sleet, depending on where you stay, right? So that's normal wear and tear to your property. So the government understands this. So what they do is give you a deduction to account for the wear and tear, right? And they give you a deduction each year for the life of that asset. So if we're talking about rental properties, residential rental properties from a tax perspective have a 27.5 useful life. That's the life of that asset.
So for 27 years, every single year, unless you take accelerated depreciation, you can take a depreciation deduction every single year for 27 years.
Absolutely. You get a deduction every single year. You do the standard kind of depreciation. Okay.
And what sizes are these? Like, how much money is that realistically saving?
It depends. So we can do a quick little calculation if you want to
do
that.
it. Yes.
Let's do a quick little calculation. So let's say a property is, we're going to make it really simple. Let's say we got a $250,000 property, right? $250,000 property. This is not including the land because land is not depreciable. Okay. So let's divide that by 27.5. That's about a $9,000 deduction every year for 27 and a half years. Okay. So that's like standard straight line depreciation. That's a simple example of that. Okay. So that's a nice amount of deduction.
$9,000. And this is for homeowners and real estate investors, or is it just for real estate investors?
Great question. So if it's your primary resident, meaning homeowners you don't get the depreciation deduction. Right? If you are an investor, you do get the depreciation deduction. That's the benefit of being an investor.
Gotcha.
Right?
Okay.
Yep. So that unlocks the depreciation. So just in that simple example, if we take that $250,000 home, and that's just the building, we do straight line depreciation divided by 27 and a half. That's around $9,000 every single year for 27 and a half years. Okay. So if you look at the income that you're probably going to get from renting plus all the other expenses, you're probably going to have a loss in a lot of instances. And those losses can potentially help you reduce your taxes in other areas if you meet certain exceptions.
Okay.
Yeah.
Okay. I'm starting to understand.
Got me? Yeah.
What about accelerated depreciation? Are a lot of people doing that instead of standard straight line depreciation, or are they taking like a bigger depreciation up front?
Got you. That's a great question. Before I answer that, let me just say this. The kind of juiciness of depreciation is that outside of your initial acquisition of the asset, it doesn't require you to spend money to get the deduction. That's the beauty of it. So think about it. In business, we both are in business. If we want a deduction or a write-off, we got to buy something to get it in a lot of instances, right? I want to write off for supplies. Let me go spend some money. A lot of people want to spend money, right? Depreciation allows you, outside of the initial acquisition of the asset, to get a deduction without spending money.
Dang. And we don't have anything like that in like my business. I'm trying to think, because I would have to have some kind of like asset that would fall under that. And I don't have anything.
So you might have things, but they probably are smaller, like any equipment
like a
that you may
laptop.
they're probably a lot smaller, but it's not like a home, right? So that's the benefit. And that's what people are using. So you'll see a lot of real estate investors, they'll be cash flow positive, like in real life. The way I like to say it is, in real life, I made money, but in my tax life, I showed a loss. Because the depreciation allows you to reflect the loss. But in real life, you got the cash in your pocket. You didn't have to spend any money to create the loss. So that's benefit.
Now, the deduction, that is deducted against what kind of income?
Great question. I love that question. Typically, and I still got to answer your other question, but typically rental properties are passive. Okay. And passive losses can only be used to offset against passive income. Okay. That's typically. So let's say if we have a W-2 job that we go work and we invest in real estate, or we have a business that we're materially participating in, we're actively involved in. Our losses from our real estate will not deduct the income from those other activities. Those are passive, unless you meet certain exceptions. So there are exceptions within the tax code where you can unlock those passive losses and make them active so that they can reduce your income from your W-2 job or your business that you're running.
Okay.
But you did ask me a question about accelerated depreciation, right? So yes, a lot of real estate investors, what they like to do is try to accelerate depreciation. And that just means that instead of taking the deduction over 27 and a half year, every single year, which that's a long time, I like to take the bulk of it earlier, significantly earlier. And you can do that through utilizing certain things within the tax code. And we can get into it, but we can go deeper and deeper. So just let me know.
No, I don't want to confuse my audience, because this is next level. And I'm sure we've already lost like half of them where they're like, this is so confusing. confusing. But essentially, it sounds like the takeaway is specifically if you are a real estate investor, you could be taking losses on your taxes or deductions on your taxes without having ever spent a dollar. Obviously, you spend a lot of money up front, but every year you get to take a deduction off of your taxes and write it off against your passive income that's coming in through the real estate side of things, unless you're doing other strategies. So realistically, you're saving thousands every year minimum, depending on how many properties you have.
Yeah, I've seen people that made a ton, $400,000, $500,000, even $1 million, and not pay any taxes for a couple years.
Because of their depreciation deductions?
Because of their depreciation deductions. Because they own enough real estate where they're able to accelerate the depreciation deduction. And they're meeting those other exceptions that I alluded to, and they're using that to reduce their income. I've seen that happen.
That's insane.
It is very insane.
Dang. Wow. That's wild. Okay. It's one of those things where it's like, if I ever got into real estate, I would not want to figure this stuff out myself. I would absolutely be hiring a team to be like, all right, you tell me what to do and I will be the money bags doing it. That's it. That's my ideal real estate investing. But I know that comes with risk too, because you have to really know the person, trust the person, and know that's like valid advice. But I guess you could say that in literally every aspect of finance that we're working in. So interesting. But what about for a regular homeowner? I still feel like regular homeowners talk about all the great tax savings of just like owning a home. Is that, would you say that is true? Would you say that's worth it? Do you think that's like a valid reason for somebody to be investing in a home? Now, granted, I don't want to shit on home ownership. My followers, I believe, this is my take on home ownership, is a lot of people believe their home is a good investment. But a lot of times, if they never ran the numbers, it's not necessarily a good investment. It doesn't have to be. Your home does not have to be a good investment. It can just be a place that you love and you wanted to live. But the idea that a home is always a good investment, I think, is a farce.
I'm with you on that, honestly. I'm with you on that. Because a lot of people, they just look at, okay, I'm paying this much in rent and I'm going to pay this much in mortgage. I need to own a home. You know what I mean?
Not at all. Then that's one of the excuses I often hear is I'm saving so much money on taxes. And I'm like, but are you really? Like, how much money are you really saving on taxes? So for you and your experience, do you feel like there are as many homeowner benefits in the tax code as well, or are they pretty minimal?
It really depends on, okay, so let me tell you this. If your home is your primary, the only way you can utilize it to get tax benefits is if you itemize your deductions, is taking a standard deduction, okay? So back when the standard deduction was significantly lower, you would see a benefit in using your home and taking the mortgage insurance, the mortgage deduction, and all of those things associated with your home to increase your itemized deduction to be greater than your standard. Before the standard deduction got bumped up. This happens with the Tax Cuts and Jobs Act. Right now in 2022, I think it's like $12,950 in 2022. So it's significantly higher. So what you've seen and what I've seen in practice is that a lot of folks that used to itemize, they actually take the standard deduction now because you have to itemize in order to take the advantages of the home tax deductions that you actually get, along with charitable contributions and all of that good stuff. So it's never just you own a home for the tax benefits. It sounds good, but you got to look at your specific situation. If you don't have enough to itemize, it's not really going to help you because you're taking a standard deduction anyway.
And if you are getting a tax write-off for your home that's larger than the standard deduction, wouldn't that mean that you're paying a lot in taxes or a lot in mortgage interest?
You know what I mean?
Yeah, because that's a lot of money to get over the standard deduction if we're looking at just mortgage interest and taxes. Because property taxes also can be deducted, correct?
Yep, so you get your real estate taxes as well. So I would never advise anybody to just get a primary resident for the tax benefits. I'm like, I wouldn't do that. Now, investment property for the tax benefits, now we can have a conversation. All right, why do you want to do that? Okay, to get an additional stream of income plus the tax saves. Now we're talking. Primary resident, not for tax reasons. Not really.
For other reasons maybe, but okay. That's good to know. That's so interesting to me. It's still just like this unknown territory for me where I'm just like, I don't really want to do it.
And I actually bought a home. Yeah, I actually bought a home. I was like you, actually.
Mm-hmm.
I actually bought a home late last year, a primary resident. The deal was just too sweet, so I had to scoop it up. So I'm super frugal. So it was just an amazing deal. But what I was thinking about doing is house hacking, just to get me into an investment property where I
For
rent out
sure.
one side, I live in the other, at least for a year, just to lock down the FHA,
Yeah.
that down payment and all of that good stuff. That's what I was thinking about doing. But this deal came by, and I was like, all right, let me just jump into this.
So from the house hacking perspective, would you then be classified as an investor who would be able to take depreciation, or would you still be classified under just like a standard homeowner?
Partially, right?
Okay.
Because part of it is investment property because you're
Mm.
collecting rent and all of that good stuff. And the other portion is primary resident. You got to separate the business use of it from the personal
Mm.
use.
Okay.
That's how
So
that
you would
works.
benefit a little bit, and then you also
Benefit
get
a
that
little bit.
stream of
Yep,
income.
yep.
And then eventually when you sell it or when you replace your own self with a tenant and move out and get another place, then it would be a full investing. Okay. You guys can tell I'm like struggling with my words. I'm like, and then you do this and this makes sense. I'm like, we're out of index fund territory.
I love them too, so it's all good.
Oh man, I love it. If there was somebody who is like, this sounds interesting and I might want to get into this, what is one thing you wish people knew more about when it came to real estate and taxes?
Yeah, so what I would say is that from a real estate perspective, it's just a way that you can diversify your investments, right?
Mm-hmm.
So I invest in a little bit of everything. I love the stock market because that's what I learned first when I was coming up. I've always been heavy in the stock market, and I was so much against real estate for a long time until my family got into it. Like, no, I could just get me some REITs. REITs are easy to get into. I can lay back my phone and I bought some REITs today. You know what I mean? I'm invested in real estate, which you are indirectly, you are, but there are pros and cons to both.
For sure.
But I would say from a physical real estate perspective, it's a way for you to diversify your investments and still get some tax benefits while doing that and get the additional cash flow as well. So I would say just look at it from that perspective, a way to diversify your investments.
Yeah, for sure. And I will say there will be people on this saying, what about the ethics of being a real estate investor? And what I always like to talk about when it comes to the ethics of it is I feel like the mom and pop real estate investors, the people who are scooping up a couple of properties or a couple dozen, maybe are not the issue. I feel like the issue is the BlackRocks of the world. These huge firms that are coming through buying up entire subdivisions that are causing the issue. What would you agree in your experience with real estate?
Yeah, I would say that's where the issue is. It's not the smaller folks. It's not the folks that I normally deal with and talk to. Not those folks. They're doing pretty well. And I have someone, like I told you, I have a couple folks that hit 7 figures and things like that. But the majority of folks are small business people like you and I that are just using their money to invest in real estate. So you don't see
provide housing.
Yeah, provide housing. The government's, hey, we'll give you benefit for that. So that's the majority. I don't see the problem with that group of folks.
For sure. No, that's how I feel about it as well. And it's in my experience when I had like a mom and pop kind of landlord, it was always a better experience than having a huge property management company and I get it. A lot of mom and pops are also using property management companies, but it still was a much better experience when I was I'm still a renter. I don't know what I'm talking about. Awesome. I love it. I feel like I learned a lot and I appreciate you sharing your passion about taxes and real estate with us. Where can people find you? Promote yourself. Tell them all about you.
You can find me all over social media my ad name is Rhythm Accounting. So that's across all social media. I'm on Instagram. I'm on Facebook still. I'm on Twitter and I'm on TikTok now. TikTok is a weird place for me, but I'm trying to learn it. You learn it, but I'm all over the place. Or you can hit my website at rhythmaccounting.com. So awesome. You just look me up. Yep.
All right. And we'll put links to that everywhere in the show notes. So my final question that I ask everybody is, what is your very first money memory?
Oh, man. Very first money memory. It doesn't have to be good or bad.
It could be either.
So my very first money memory when I got my first job. When I got my first job, I was a teenager at the time. So I was riding high. I was the man. I got my own money. I had $500 in my pocket. I worked overtime. I worked at this golf course. I was working outside, cleaning up the greenery and all that type of stuff. But I felt like the man. I had a girlfriend at the time, so we were riding. And that one weekend, my very first check, I had $500. And that one weekend, I blew all of that money.
Oh my
God. What
did you remember? What did you buy?
I was buying food. We went out to eat. We went to the movies. We went to the mall. I was buying stuff for me, buying stuff for her. I'm like, yo,
you were straight balling. That's
Come
amazing.
on now. I was a teenager. I was like, baby, you ain't gonna get what you want. You get whatever you want. It's on me. I got you. Daddy here. It's on me.
Oh my gosh.
I blew all of that money. As a teenager, I probably was like 16 years old, but I thought I was a man. But that just showed me, I'm like, okay. I didn't like the feeling going back to work that next week.
Yeah,
like, I really don't have money. I can't go get me a Wendy's junior bacon cheeseburger for lunch.
Yeah. Oh my gosh. And at that age too, $500 seems like so much money. And to be fair, at 16 years old, $500 for a week of work, or was it a month?
Oh, it was a week of work.
That is good money at that age.
That was a lot of money to me. Yeah, I was balling $500 at 16. So yeah, I blew it all. But that taught me a lesson. I hated the feeling going back to work. I was like, I need to start saving some of this money.
That's funny. So then after that, did you start saving a portion of your income?
I started saving a portion every single time I got paid. I was like, all right, let me put a portion right here. I wasn't investing yet, which I wish I would have known about that at that time. You know how it goes. Yeah, but I was at least saving it. So my savings account I had some money in there, and I enjoyed the feeling of not having to wait until my next paycheck to have money.
To access money. Yeah, for sure.
That taught me the lesson. Yeah.
No, I feel the same way. I had a post the other day where I was like talking about all the different ways that you could become a millionaire, just like a couple of different scenarios. And one of them was like, start working at 11 and have an adult open an IRA for you. And so many people were like, start working at 11. I'm like, bro, I was working at 9 years old because I wanted to have money. I was doing like concessions and things like that. If I had just taken half of it and invested.
Oh my God.
Oh my gosh. But these are the regrets we live with as adults. So if you're listening now and you still haven't gotten started, this is another reminder to get started.
And get your kids started, or your nieces and nephews, because I preach this stuff to them all the time. You know, I was like, oh, you're working at Chick-fil-A? Invest. Open a Roth account. Like, let's go.
You will thank yourself. And once you understand the power of compound interest and time, it's just a game changer. So
it really is. Yeah.
Awesome. Thank you so much for coming on today. I hope folks didn't get too overwhelmed with that depreciation and acceleration, but I thought that was really interesting.
Thank you. Thanks for having me.
Of course. And that was Ronnie Goode, my friends. I love Ronnie. He's such a lovely human being to be around. And like talking to him about taxes, like I find taxes to be one of the most boring topics that I could possibly talk about, but he is so passionate about it, and his knack for understanding and being able to explain things like how to save money on taxes through real estate is unmatched. So I hope you guys enjoyed him too. Be sure to check out the show notes to follow him on all the platforms. Great human being, great speaker, and I'm so glad I got to have him on the podcast today. So hope you guys enjoyed it. As always, friendly reminder that this is a podcast. It is not financial advice. It's for opinion, entertainment, education only. And if you guys want to check out our full terms and conditions, head on over to the show notes for that. And of course, if you've made it this far and you're wondering, how the heck do I start my money journey? Head on over to the lazyinvestorscourse.com/guide to download our free Get Your Money Guide to start your financial journey today. So that's all I've got for you guys this week. I hope you have a good one, and I'll see y'all next week. Bye-bye.